Welcome back to another segment of Arizona Mortgage News. We're here with Mike Goblet, our resident expert from United Mortgage and Financial Group. Today we're going to cover the second part of a 10-part series on what you need to know about mortgages. And Mike, what's today's topic?
Today's topic is qualifying for a mortgage. What's the process to qualify for a mortgage? So it really starts with an application, okay, which actually I can do over the phone in about 15 minutes generally, or can email a copy of the interview form that I use to somebody to complete and then resubmit, okay? So once that happens, I then need to take the information I gather, pull the person's credit so that we can tie it to a couple of factors. Number one, I need to determine the income ratios versus the debt. So it's called DTI, debt to income ratios. And then number two, to find out if there are any derogatories on the credit report that would not only just give me the score, which I need, as we talked about in a prior segment, but derogatories that could impact the ability to qualify, like a BK, like mortgage lates that we've talked about in that information. So there are two key ratios in terms of the DTI that I talked about. And that is number one, what they call the front end ratio, and that's your new mortgage, including all that's attached to it, meaning principal, interest, taxes, and insurance, even HOA fees, if there are any, to that property, should not exceed more than 38% of the person's gross income, okay? And then the back end that they call, that's your total debt to income ratio. That's where we go in, look at everything showing on your credit report, plus the mortgage, so credit cards, any other mortgages or anything you have showing, and that should not exceed 43% technically, but with enough variables, the automated system will often let you go up to 50%. So the generalized is 43, but there can be some exceptions that may let you get to 50% of your total debt to income ratio.
And what are some of those variables, Mike?
Reserves, your credit scores, really, the reserves meaning your assets backing, your credit history, how long you've been established. You can also picture, you might get to 50%, but 50% of a $2,000 a month is not the same thing as 50% of $10,000 a month. So your disposable income makes a factor in those as a variable as well.
Makes sense.
So the next step, if you're purchasing, is you need to get pre-qualified or pre-approved through this process of the application. Now, pre-approval or a pre-qualification is kind of what I just mentioned above. We generally look at the information and say, yeah, based upon everything you've told me and what's on your credit report, it looks like you'll qualify for this mortgage. That's different than a pre-approval, which means we take all that plus all the support material that will come about. We'll talk about that in a moment, and send it to underwriting to get a pre-approval.
Very good.
Okay. Now we can even do a pre-approval on if you're purchasing on a to be determined property, meaning you can come to us saying, I want to get pre-approved, but I don't have a purchase offer in place. Well, we can do that with many lenders that will allow TBDs, to be determined properties, to go through the process. That makes you a stronger buyer having a pre-approval over a pre-qual because you've already been through the underwriting review. Now we just attach it to the property.
Good point. That makes a lot of sense. Obviously, the seller is going to look much more favorably on that.
Exactly. exactly. It's stronger reason to consider your offer. So once we have the cursory pre-approval, we need full documentation. And what they mean by full documentation is we need to see your pay stubs if you're a W-2 employee. We need to see the W-2s, usually from the previous 2 years. Bank statements for the previous 2 months, photo ID, tax returns, particularly if you're self-employed or receive a lot of income from investments or other sources that may take you higher in a tax bracket. They want to see all that and see what you write off. If you're not a citizen, they want to see the documentation that will allow you, the green card, H1, all the different variables in terms of that. So the legal documentation. If you had a history of a BK, but now fall into the category, for instance, that allow you to qualify, they're going to want to see your discharge information, what was included in the BK. If you have child support payments or a divorce, that often will require a copy of the decree, the divorce decree, so all the particulars can be seen and that the underwriting can make sure there's nothing being hidden that could come up in the future.
And what is the time frame for BK before you're eligible again?
Well, that really is going to be dependent upon the mortgage you're trying to qualify for. A conventional mortgage after a BK is, I think, what is it? BK is 4 years. A foreclosure is 7 years. But you can often qualify for government support programs earlier than that. A VA, an FHA, it gets reduced. So we have the ability to marry you to the proper program that you then qualify for.
Very nice.
Now, underwriting, which is, part of what we're talking about, generally the initial will take 3 to 5 days to have an underwriter review it, and then they come back with, okay, everything looks good, but we want to see this additional documentation, or these things have to happen. For instance, it might be in some cases, if you have collections, sometimes they make you pay off those collections. So that's where an underwriter comes back and says, I need these things to happen.
Makes sense.
The other piece in getting qualified, we just talked and you brought up what's the time frame. If you've had a history of a BK or a foreclosure and now you fall into the window of qualifying, you want to start that process usually about 6 months ahead of when you actually want to qualify. Sometimes you're prohibited from making an offer before the exact time period by day from when the discharge was or the foreclosure sale date, but you want to begin the process of knowing where you are, what your credit is, about 6 months in advance.
Seems reasonable.
So overall, right now, you can expect a mortgage process to take about 30 days. Uniquely coming up August 1, the government is adding into it what they call TRID, okay? And it has to do with the new RESPA laws and disclosures and everything that will be attached. And the expectation is it will take no less than 45 days starting in August 1 with the implementation of the TRID laws and the new disclosure laws. I'll talk about that more in the future.
Okay, excellent. I'll hold the questions.
So, okay, Matt.
Very good. Well, Mike, as always, great information. We're part 2 into a 10-part series. What do we have in store next?
My next topic was going to be a very important term that a lot of people don't understand, and that's LTV, loan to value ratio.
LTV, excellent. Well, Mike, for those that have questions and want to reach out to you, what's the best way to get in touch?
Well, you can call me here at the office at United Mortgage Financial Group, 480-503-3533. call me direct on my cell phone, 480-220-2329, or email me at mike.goblet at our company initials, umfginc.com.
Well, excellent. Well, as always, a pleasure, Mike. We'll look forward to the next segment.
Thanks, Matt. I look forward to talking to you in the near future again. Take care.